Hello, and welcome to Taxes in 10, where we take a tax topic and break it down in 10 minutes or less. My name is Mark Barnes, and I'm the managing partner of Copper Canyon Tax and Accounting Services in Tucson, Arizona. We are a boutique firm that specializes in small business accounting and taxes. This episode is on tax projections and calculating estimated payments. The United States income tax system is a pay-as-you-go system, which means that you must pay income tax as you earn or receive income during the year. You can do this either through withholding from your wages, your pension, or certain government payments such as Social Security, or by making quarterly estimated tax payments during the year. While there is no provision in the code that requires a taxpayer to make estimated payments, the code does impose an addition to tax on individuals for underpaying. Individuals who do not pay enough by the due dates of each payment period may be charged a penalty, even if they don't owe any tax when they file their tax return. In addition, if they didn't pay enough tax throughout the year, either through withholding or by making estimated payments, they may have a penalty for underpayment of estimated tax. As practitioners, it is our job to assist clients with tax-related issues. A change in the taxpayer's life is the perfect time to show our value and to help solidify our relationship with the client and our position as their trusted advisor. Changes in their life, such as marriage, and better tax rates if one spouse earns significantly less money, or the SALT caps, or their ability to deduct real estate losses when their combined income will exceed $150,000. Divorce or separation, and the need to withhold at a higher rate if filing single by the end of the year. Having a child, the $2,000 child tax credit. A child turning 17 or going to college, and the American Opportunity Tax Credit and the new $500 credit for other dependents. Or if they're working a second job, where they will likely have zero or very little tax withheld. Or if they receive any other income without withholding, it'll affect the amount of taxes they owe. Some of these other sources of income could include a self-employed person who operates a business as a sole proprietor, partners in partnerships, independent contractors, someone running a home-based business, direct sales, or driving for Uber or Lyft. You also have investors who receive interest, dividends, and capital gains from sales of investments. Property owners who receive rents and royalties. Retirees who opt not to have tax withheld from pension payments or Social Security. And recipients of alimony paid as a result of a divorce or separation agreement signed before December 31st, 2018. Remember, the Tax Cuts and Jobs Act ended the taxability of payments made under agreements reached after December 31st, 2018. This is found in Internal Revenue Code, Section 71. Or income from installment sales. To calculate estimated tax, an individual must determine his or her expected adjusted gross income, taxable income, taxes, deductions, and credits for the year. Here is the 10-step process. Step 1. Estimate taxpayers' expected adjusted gross income. Include all taxable income, even if it was already subject to withholding. Subtract out any adjustments. Step 2. Reduce adjusted gross income by either the expected itemized deduction or the standard deduction and any expected adjustment under Section 199A. Step 3. Calculate expected income tax. Step 4. Calculate expected tax credits. These are the non-refundable tax credits. Step 5. Calculate income tax after subtracting out the tax credits. Step 6. Calculate expected self-employment tax. Don't forget to subtract 1/2 of self-employment tax from their adjusted gross income. Step 7. Calculate any other expected taxes. Step 8. add together the expected income tax after credits, expected self-employment tax, and any other expected taxes. Step 9. Calculate any expected refundable tax credits. Step 10. Subtract any refundable tax credits from the expected tax liability in Step 8. This total is your basis for calculating the required annual payment. Let's take a look at our first scenario. Jack and Diane are a married couple with one child. Jack expects to earn about $60,000 this year, and his W-4 shows married with one exemption. That results in $4,784 in federal tax withholding. This number comes from Pub 15, Circular E. Diane is self-employed and expects to make about $35,000 in revenue. She will have a few expenses and a small home office in their apartment. Her estimated expenses are $5,000. They pay about $300 per month for daycare, and they will both contribute $2,500 to a traditional IRA. Step 1. Add income, which is $90,000 jointly. Subtract off adjustments, which is our IRA contribution, and 1/2 of self-employment tax. Total $82,881. Step 2. Next, we should subtract the standard deduction. Then calculate the qualified business income deduction. Remember, it is the lesser of QBI or taxable income. To arrive at QBI, we take $30,000 in net self-employment income, which in this case is less than the taxable income, and subtract 1/2 of the self-employment tax. There is not an adjustment for the IRA, but there would be an adjustment if it was a SEP, a simple, or a solo 401k. Step 3. Take our adjusted gross income, $82,881, subtract the standard deduction of $24,000, and subtract our qualified business income deduction of $5,576 to get to $53,305 of taxable income, which results in $6,018 of federal tax liability. Step 4, calculate our tax credits. We have one child under 17, so we have a $2,000 child tax credit, and we have $3,000 in qualifying dependent care expenses, which result in a $600 tax credit. Step 5, calculate our tax. $6,018 tax liability minus our $2,600 in tax credits results in $3,418 of federal tax due. Step 6, calculate our self-employment tax. $30,000 times 0.9235 times 0.153 equals $4,239 self-employment tax due. Step 8, add our expected tax after credits to self-employment tax. This results in $7,657 of tax due. Step 9, tax due minus our withholding leaves us with a balance of $2,873 due. Now we know that Jack and Diane will owe just under $2,900 in tax, and we can take action. Personally, I'm going to round this up to $3,000 or maybe even $3,200 and have them make estimated payments of $750 or $800 per quarter. Because we anticipate her income to be earned throughout the year, 4 estimated payments should be made. The due dates: April 15, June 15, September 15, and January 15. Note, if an individual does not have income subject to estimated tax until a later payment period, they should make their first payment by the appropriate due date. Let's take a look at another scenario. Another real-life situation that I run into fairly often: the sale of a rental property. This taxpayer does not have any carry-forward losses, and because his gain is less than the depreciation allowed or allowable, It's a straightforward calculation. Let's determine his gain. The original purchase price, including land, is $112,008. Improvements made prior to placing in service, $64,584. Cost of sale is $21,237, which is added to his basis. If your client is considering selling, you can estimate the cost of sale so you can complete a tax projection. Keep an eye on the average sales costs in your area as your clients buy and sell real estate. This gives us a gross basis of $197,827. From that, subtract our depreciation allowed or allowable, which in this case is $84,447. That gives us an adjusted basis of $113,380. Subtract that from our sales price of $161,000, and my client has a gain of $47,620. Now we need to split the gain. First, we have unrecaptured Section 1250 gain. Unrecaptured Section 1250 gain is a type of depreciation recapture income that is realized on the sale of depreciable real estate. Unrecaptured Section 1250 income is taxed at a 25% maximum capital gains rate, less in some cases. Any gain above the 1250 gain is a traditional capital gain. In this case, the total gain is less than the depreciation allowed or allowable, so his entire gain is unrecaptured Section 1250. If you look in the upper right corner, you can see I noted the sales date of December 28. So when I prepare his tax return, I will complete Form 2210 and add this gain in the fourth quarter along with the $10,000 estimated payment my client made. Make sure to hit the subscribe button to keep up to date on all of our Taxes in 10 video series. If you are interested in earning CE on this topic, please visit potentialcpe.com for a list of all the courses we provide. Our 1, 2, and 4-hour on-demand webinars will focus approximately 75% of each hour educating theory and regulation, and 25% on real-life examples, where we'll walk you through completing the forms and schedules and help you increase your potential.